Altria Group offers investors a dividend yield of 8.23%. But is that dividend safe? Is it sustainable? That's what I'm going to answer in this video by looking at some of its metrics. Starting with, of course, for me, most importantly is the ratio of dividends per share to earnings per share. I like to see higher earnings per share compared to dividends per share because, like a household, a company cannot sustain a dividend per share that's higher than an earnings per share. That's like a household spending more money than it brings in income. Sure, you can sustain somewhat by using your savings, by borrowing some money to maintain your spending, but longer term, you need to bring your earnings up to your spending to be sustainable. That's what I look at for earnings and dividends for companies, which shows a big red flag here when I look at this metric for Altria Group. From 2020 until most recently, Altria Group's dividend per share in the orange here has outpaced its earnings per share in the trailing 12 months. Now, the company has done a good job closing this gap, but it's still a gap here in favor or against Altria in terms of a higher dividend per share compared to an earnings per share. And so this is not sustainable, and so the company needs to bring up its earnings per share, or it needs to bring down its dividend per share. If it brings down the dividend per share, obviously that will decrease the dividend yield, which is why I say this metric is very important when you're trying to measure if the company's dividend yield is sustainable. Now, if we look deeper and we understand that the company's primary business is selling cigarettes to US customers, and we understand that the volume has been falling for several years now, that puts this into more question, right? Now, when you understand the underlying business is in decline, it puts an even bigger red flag at this business. But let's look deeper before we write this off and we say that it's not safe. Let's look a little bit deeper. If I look at the cash flow from operations to the total dividends paid in aggregate, this paints a greener picture, a more healthier picture. If I can say healthy for a cigarette company, I probably shouldn't use this word in any moment in this video, but here we are looking at the cash flow from operations. You see 8.16 billion compared to 6.599 billion in the most recent year. So cash flow from operations is significantly outpacing dividends by more than 1 billion in every year for the last 5 years. The difference between cash flow from operations to earnings is there are some non-cash expenses that companies incur, things like depreciation, things like stock-based compensation. Although longer term, those tend to turn into cash expenses. Shorter term, you might say depreciation is a non-cash expense, but machines need to be replaced and buildings need to be updated, and that money goes back in every 5 years or every 10 years or whatever the reinvestment cycle might be. So I prefer to look at earnings per share to dividends per share as being more informative, but the cash flow to dividends looks a bit more favorable for Altria Group here. And the last thing I'm going to look at here is the total cash compared to long-term debt. If the company is imbalanced in terms of earnings per share to dividends per share, but it's got a massive load of cash and not very much debt, then the company can sustain paying a dividend out of its savings because it's built up such a massive savings. But that's not the case here for Altria Group. It's got 26.68 billion in long-term debt and just 3.9 billion in cash. So it's got way more debt than cash, so it cannot support its dividends longer term from just paying out from savings, right? So that's not an area it can support the dividends from. So to answer the question I posed in the headline, is Altria Group's 8% dividend yield safe? I'm going to have to say no, it's not safe. The company's earnings are not sufficient to support this longer term, and looking at the underlying business, you can see significant volume declines in its cigarette business. I would say for investors looking at the tobacco space for a healthy 8% dividend yield, look at British American Tobacco. I should have a video up on that. Look at that stock. I think that has a more sustainable dividend if you're looking for an 8% dividend yield from a tobacco company. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.